Hi everybody, and welcome back to video number 5 in chapter 17. And when we left off, we were looking at the summary of the 5 steps. Here in step number 4, we're allocating the transaction price to separate performance obligations. And if more than one performance obligation exists, we're going to allocate the transaction price based on relative fair values. The best measure of fair value is what the good or service could be sold for on a standalone basis, a standalone selling price. Estimates of standalone selling price can be based on adjusted market assessment, expected cost plus a margin approach, or a residual approach. Step number 5, we're going to recognize revenue when each performance obligation is satisfied. A company satisfies its performance obligation when the customer obtains control of the good or service. Companies satisfy performance obligations either at a point name, a point in time, or over a period of time. Companies recognize revenue over a period of time if one of the following criteria is met. 1, the customer receives and consumes the benefits as the seller performs. Number 2, the customer controls the asset as it is created. Or number 3, the company does not have an alternative use for that asset. All right, let's apply this 5-step model and put it into practice. Here, the Ace Appliance Company manufactures compact appliances, stoves, microwaves, refrigerators, which are in demand for use in dormitories, hotel rooms, and efficiency apartments. One of the most popular products is a combination of stove microwave, which can be installed in a safe, space-saving manner under counters or in cabinets. Each unit has a retail price of $800 with a cost to Ace of $350. Ace sells its products under a written contract, which indicates the customer's and Ace's rights and responsibilities on the sale of each unit, and collection on the contract is probable. Ace sells its appliances on a standalone basis directly to customers, as well as provides installation services. Installation services are not specialized, and customers could hire other vendors for those services. Ace sells 400 stove microwaves with installation to a hotel for use in 3 of its new properties for a total price of $320,000. Ace provides installation services at a standalone selling price of $100 per unit. The cost to Ace to install is $50 per unit. The stove microwaves are delivered on April 1, 2025, and the installation is completed on May 20th, 2025, and full payment is made to Ace at the delivery of those appliances. Okay, Alpha. Evaluate each of the 5 steps in the recognition process for this revenue arrangement. The sale of the appliance and the installation are accounted for as separate performance obligations. So, here, with respect to the 5-step model, 1, we identify the contract, and Ace and the customer have entered into a written contract, which entails approval and commitment of the parties and identification of the rights and payments terms. Collection is probable. Number 2, we identify performance obligations. There are 2 performance obligations. 1, delivery of the combination stove microwaves, and 2, its installations. These promises are distinct and given installation could be done by another vendor and installation has a standalone selling price, ACE concludes that the installation is separately identifiable from the sale of the appliance and should be accounted for as a separate performance obligation. Number 3, we're going to determine the transaction price. The total transaction price is $320,000 as specified in the contract. It is the amount that ACE expects to receive in exchange for the goods and services. Number 4, we need to allocate that transaction price between the appliance and the installation. And we'll do that based on standalone selling prices. So the equipment was $320,000. We're going to divide that. Let's go back. Here was the $320,000, right? And the standalone selling prices were $320,000 and $40,000, total of $360,000. So we take the percentage, multiply it by 320,000 to get 284,444, and the installation is the difference between the equipment and the total standalone price. And here is the breakdown of that 360,000 standalone price. 400 stove microwaves at $800 each, and 400 installations at $100 each, total $360,000. So pretty straightforward there, how to allocate that. Then we recognize the revenue. The control of the stove microwaves transfers upon delivery on April 1, 2025. Sales revenue and cost of goods sold are recognized on that date. The installation revenue is recognized on May 20th, 2025, when the installation is completed and ACE has satisfied its installation performance obligation. Okay, going back, under Bravo here, they want to prepare the journal entries for ACE on April 1 and May 20th. And it's going to look like this. Here, we're going to receive the cash for $320,000. We'll reflect cost of goods sold, 400 units at $350 per unit. And then our inventory will have gone down by that much. And sales revenue will be recorded at $284,444, which you'll remember was the allocated price for equipment. And then the unearned service revenue installation will show as a liability. Then on May 20th, we'll reflect that we've earned that $35,556 and credit earned revenue for the installation. And we also have installation expense here for $20,000, and that's comprised of cash, wages, and other materials. Now, under Charlie, what amount of income related to this arrangement will be included in ACE's 2025 income? Well, the income included is going to be here as our allocated sales revenue from the equipment and the cost of that, our gross profit. And then below the line, we have installation revenue here and the expense of that installation revenue. So we have net profit on the installation. And the net income on this arrangement, therefore, is $160,000. That's assuming both delivery and installation occur in the same accounting period. It is possible, of course, that they could be in different accounting periods, but in this case, it was in the same accounting period. Okay, then if we look under Delta here, assume now that the customer signs and ACE accepts a note as consideration in the contract to be paid in 6 months briefly discuss how collectability of the note affects revenue recognition and income measurement for ACE. Well, for Delta here, if not probable that the company will get paid for satisfying a performance obligation, this raises concern about the existence of a valid contract, naturally. If collection is not probable, ACE cannot recognize revenue until the payment is probable. Only then, or when all amounts are paid, can ACE recognize revenue on this contract. Okay. Now, as we move, we're going to apply the 5-step process to major revenue recognition issues. And here, when we're accounting for revenue recognition issues, we have several of them: sales returns and allowances, repurchase agreements, bill and hold, principal agent relationships, consignments, warranties, and non-refundable upfront fees. Okay, let's take the first one, sales returns and allowances. The right of return is granted for product for various reasons. Customer is just dissatisfied with the product for whatever reason. The company returning the product receives any combination of the following: 1, full or partial refund of any consideration it paid. 2, credit that can be applied against amount owed, or that will be owed to the seller, or sometimes we just exchange it for another product. Let's take a look at an example. Here on March 5th, 2025, Epic sells 100 video games on account to GoGamer for $50 each. The cost of each game is $20. Epic allows GoGamer to return any unused video games within 60 days of purchase. Epic estimates that 1, 6 video games will be returned. 2, the cost of recovering the product will be immaterial. And 3, returned video games are expected to be resold at a profit. On March 24, 2025, GoGamer returns 4 of the video games because they were for the wrong gaming system. On March 31, Epic prepares financial statements and determines that it is likely that 2 more games will be returned. So the questions: Alpha, what entries should be made on March 5th, 2024 and March 31st by Epic to record the information related to the sale of these video games? And Bravo, how would that information be reported on Epic's income statement and balance sheet related to March 2025? Well, for Epic's going to make the following entries on March 5th and then March 24th as follows. They're recording the sale of the games here, $5,000, $100 units times $50, and the cost of goods sold. Pretty standard journal entries there. But when they returned 4 video games, there were 4 at $50, the cost was $20. So we're going to show a debit to sales returns and allowances, a credit to accounts receivable for $200, and the debit to returned inventory, and a credit to cost of goods sold for the cost of that. And the sales returns and allowances, of course, is a contra account to sales revenue. The returned inventory account is used to separate returned inventory from regular inventory. And then on March 31, 2025, it's going to prepare its financial statements, and originally estimated that most likely outcome was that 6 video games would be returned. Epic believes the original estimate is correct. And on March 31, then we're going to show an additional 2 sales returns and allowances and refund liability. That looks like a good place to stop this video. And when we return, we'll take a look at the rest of this example.